Assalamu alaikum friends, welcome to question number 24 of SBR revision kit. So as you can see that we are being given the background. I'm going to read a little bit later after I go through the requirements. Okay, then we have share-based payment, which is your IFRS 2. And here you can see they have given you the marks, 4 marks. The director's son, okay, 3 marks. So this looks like it is related party. So you can say it is IS 24. Operating segments, IS 8. Okay, so sorry, it's not IS 8, it's IFRS 8, which is for 4 marks. Now we have two requirements, A and B. B talks about ethical implications. Okay, and then we'll be getting the 2 professional marks there. Discuss the accounting and ethical implications for 7 marks. A. Discuss the correct accounting treatment of the above 3 issues for the year ended 30th November 2006. So that means according to the standard, first of all you have to tell according to the standard the treatment, then you have to say what should be done, and then you are going to say what is the error, what they have done incorrectly, and what is the impact of that incorrect treatment. So coming to the background, but before that we have to go through the background. Okay, Gartner is a public listed company with a reporting date of 30 November 2006. It owns and operates various online business. It customers orders goods through Garden's websites, and these goods are delivered by third-party couriers. At 30 November 2006, the finance director owns 15% of the Garden in its ordinary share. Garden's ordinary share and operation director. Okay, finance director owns 15%. And operation directors owns 10%. The rest of the shares are owned by the numerous other shareholders. All ordinary shares carry equal voting rights. At the most recent annual general meeting, some of the shareholders expressed dissatisfaction with the financial performance of Garden. They also complained that the directors were overpaid and they were not demonstrating effective stewardship of the company's assets. The accountant of Garden started employment during the year 30th November 2006. If you see, okay, that means she's new to the role of accountant and has encountered a number of issues. So first one is share-based payment. Now you can read all the 3 accounting issues, then answer all together, or you can read one issue and then answer another issue and one by one and then answer. I follow the second strategy because I feel it's easier, faster to do that, effective for me. So now you do whatever is effective for you. Okay, share-based payment. On 31st December 2005, a share-based payment scheme was introduced to Garden's 6 directors. The directors are entitled to 600,000 share options each. That means 6 into 600,000. If they remain employed by the company until 30th November 2008, that means 3 years. If you take from 1st of December, 3 years. So 3 years is a vesting period. It is known as vesting period. If they are not there within 3 years, they will not receive this option. Okay. The fair value of each share option was 4 at 1st of December 2005. That means at the date that option was granted, that is the fair value, which is 4. And 5 at the reporting date. That means 30th November 2006. At 1st of December 2005, it was estimated that none of the debtors would leave before the end of 3 years. It was estimated. But at 30th November 2006, that means after a year, the estimated number of leavers was revised to 1. That means 1 will leave. The finance director told the accountant that no entries or disclosures are required for the scheme. No entries or disclosures are required for the scheme. Who told? Finance director told the accountant. This could be used as an ethical issue also. Okay, when you're reading the requirements, please, the scenario, make sure that you read it from both the perspective of accounting issue as well as an ethical issue. Okay, because you are not going to read the same scenario twice, once for ethical issue and once for accounting issue. So read it once and forever. When you're reading once the first time, make sure that you understood everything, so that it becomes easier for you to write your ethical issues also. So they told no disclosures are required in the current year's financial statement because it has not yet vested. 4 marks. First we'll answer this 4 marks. How we are going to get the 4 marks? For example, 1 mark you'll be getting for the calculation because numbers are there. Whenever numbers are there means you have to use calculation, correct calculation. Second, incorrect treatment. Third, correct the treatment. Fourth, you have to use the rule. You are using the rule, stating the rule using IFRS 2. So 4 marks. This is how you are collecting the 4 marks. Okay, just so if you see here, make sure that you write the proper subheading because there are 3 accounting issues. So, and also you have to understand whether this is a equity settled share based payment or a cash settled share based payment. Very important. So now let's see. The directors have granted share options to, so this is an equity settled share based payment. You have to identify this in IFRS 2. Whenever IFRS 2 is given, share based payment, first see whether it is equity settled, cash settled, or combination of both. And if it is, then who has the option of giving it in equity? But in this case, because they are giving share options, whenever share options are granted, it is not cash. You are not giving cash. You are giving an option. So it is an equity settled share based payment. You are settling the payment by giving equity, by giving shares. Whether you exercise it or not later, that's a different case, but it will be known as equity settled share based payment because the accounting is different for this too, cash settled and equity settled. That's why you need to identify. So share options are equity settled share based payment. So now you are using according to IFRS 2. Okay, the expense should be based on the fair value of the option at the grant date because it's an option. Whenever share options are there, fair value you take at the grant date. Whatever later, if it changes, it does not matter. Ignore it. Okay, why expense? Because it's an expense for the company's point of view. They're giving share options and all, so they have to record this expense in their profit and loss account. But what is the amount of the expense? Fair value of that option at the grant date, which is what? 4 per option. 4 per option. At the beginning date, you have to take the fair value, not after it has changed after a year. That is ignored. Okay, that you have to take if it was a cash settled share based payment, but it is a share option, equity settled share based payment. So at the grant date only you have to take the fair value. The expense, remember, this expense should be spread over what? Vesting period, that is 3 year. 3-year vesting period. You don't recognize expense immediately. It will be spread across the 3 year based on the number of the options expected to vest. So you already have to record for 31st December 2005 or 6. I don't remember the year. Let us go to the requirement. 30th November 2006. That means only for the first year. So when you're recognizing it, 1/3, that means 3 years, no? It will be divided between 3. So for the first year, 1/3 of the vesting period has passed. 1 year has passed. So the finance director is incorrect in stating that no expense should be recognized in the current financial year because 1 year passed. So you have to recognize that expense. Directors are telling no expenses recognized, no disclosure should be made. So he's incorrect. He's incorrect. Always show full workings for your calculation. Even if your final answer is wrong, still you will get marks for your workings. Okay. Now you are recognizing the expense. This recognition should be expensed at what date? 5 directors are there. Why? Because we told 1 will be leaving. We assumed on 30th November 2006 1 will be leaving. So out of 6, 1 is minus. So 5 directors. 5 into 600,000 options into 4 because this is the fair value of the grant date, and 1/3 because 1 year passed by and it will be divided by 3. So 4 million. This will be the expense which will go in the profit and loss account. So this expense will be recognized in profit and loss, and a corresponding, remember you have to always say the corresponding entry. If you are debiting somewhere, you have to tell where it is credited. Okay, so it is debited in profit and loss, corresponding entry will be made to equity. It will be credited in equity because it's an equity settled share based payment. Okay, what happens? Always whenever accounting issues are discussed, especially in question 2 in your section A, you have to tell the impact on the profit of the cash flow. So this will reduce the reported profit of garden because expense, no, you are recognizing 4 million expense of profit will reduce. Now this is you are giving to whom? You don't give share options to any employees. You give share options to key management level people, right? Directors you are granting. So directors are related party. So don't forget that transaction with the director is a related party transaction. Disclosures are therefore required. Now you have to use the rule of IS 24 also here. Okay, definitely we have to use IS 24 for the director's son, but here also we have to use for the director himself, whatever the transactions you have done. So partly we have to use IS 24 also in the first issue. Okay, so this requires that key management personnel because director, who is director? He's the key management personnel. So which includes all directors. All directors are taken as key management personnel, not that he's my family member, so he's the key management personnel. The other, no, it's not like that. All directors. They are what? They are related parties of the reporting entity. You have to know the definition of all the related parties who could be related to the reporting entity. You have to go through that list, okay? If you haven't, make sure that you go through my IS-24 video, right? It's properly mentioned there who are related parties and who are not. So with regard to key management personnel and entities required, whatever this transaction is happening, entity has to disclose that because related party is required to disclose employee benefits because employees receiving their, no, it's a benefit for them. They are getting shares in the company, the directors and all. So directors are employees, are employee benefits, including share-based payment. Share-based payment is like an employee benefit. Right now we are coming to the second issue, which is the director's son. Looking at it, we know it's a IS-24 related party, but we didn't read the scenario, so we'll read it. It's for 3 marks. The wife of the finance director is the sales director of Garden. Their son is undertaking an internship with Garden and receives a salary of 30,000, which is in line with the market rate. The finance directors ordered the accountant to omit any reference to his son's salary from the financial statements. So let's see. This is quite simple and easy also to understand and write also. I don't think you will face much difficulty here. Okay, the only thing is that first of all you have to define whether he's a related party or not. For 1 mark for that. After that you have to tell that this needs to be disclosed. Okay. So directors are the key management personnel. Okay, you start by saying that he is the key management personnel himself, directors. So whoever is related to him, for example, his family member, close by, they also become a key management personnel. They also related party. So therefore, they are related parties of the reporting entity. IS-24 also says that the close family member of the key management personnel, that means close family member of the director, his wife, his son, they also will be related parties for the reporting entity of the reporting entity. So definition of the close family member, you have to tell that. Who is that close family member? It includes children also. It includes children also. Okay. So here, the son of the finance and the sales director is therefore related party of Garden, both. Both the son as well as the wife. Sales director is the wife, no? They are related party of Garden. Even though they are not related to Garden, but they are sales director and they are and son is doing internship there, in the Garden. And Garden and the finance director is the father and the wife of the sales director and son who are there, the Garden as well. So they are related party. So the salary paid to him needs to be disclosed in a note to the financial statements. Also, okay, again, that's not enough that you disclose the salary. Another thing you have to make sure is a statement could be made that the transaction is on market value terms as long as this can be substantiated. Remember, they told that it was at a market rate, right? The salary, and also you can make a statement saying that this is at the market value, the salary. Now we are coming to the next operating segment. So at the start of the current year, operating segment is a standard which does not very frequently comes, but since it came here, so it shows that it might come suddenly, it might pop out, right? You never know. So at the start of the current year, Garden purchased the trade and the assets of a fashion retail chain that operates a number of shops in a large town. Such as the chain did not sell its product online. The press was critical of the Garden's decision, accusing them of overpaying for the chain and of expanding into a sector in which they lack experience and expertise. The performance of the shops, which is monitored internally by Garden's, okay, monitored whom? Internally by chief operating decision maker. These words are very important. Remember, who is monitoring? Chief operating decision maker. For operating segment, these words are important, which has been it has been poor. So when reviewing the operating segment disclosure note prepared by the finance director, the accountant noticed that the new retail business has been aggregated with the rest of the Garden's trading options and disclosed as a single reportable segment. The gross profit margin made from the retail outlet are much lower than those made from the Garden's online operation. So from overhearing conversation, the accountant is aware that the Garden's finance director is a good friend of the former owner of the retail chain. See? He's a good friend. Whoever is the owner before in the retail chain. 4 marks. How do you start this? Number one thing that you can note is the aggregation part, because IFRS 8 also tells in which condition you can aggregate and in which condition you cannot aggregate. So aggregation is one aspect. For that you will get 1 mark. Okay, you have to say whether is this correct or not in the scenario, aggregation part and all. So you have to state the rules regarding what aggregation of operating segment is appropriate or not. Don't go and say, okay, sale 10% or more, then you report it. It is a reportable segment. Don't take the quantitative threshold, okay? The 10%, 75%. No. It's not asked here. Neither the figures are given to you. So most of you might be thinking how this question can come without numbers and all, right? It can come like this, aggregation. So you have to know the rules of aggregation in IFRS 8. And they have given certain facts and all to tell you whether you have to take it, aggregate it or not. So the main topic is that. So according to IFRS 8, okay, they are defining the operating segment. An operating segment is a component of an entity that engages in a business activity. It has to be there, okay? That part of an entity, not the entire entity, but that component, that part of an entity that engages in a business activity, that is known as an operating segment, and which has a discrete financial information also available, that is monitored by the entity's chief decision maker. That information is monitored by the entity's chief decision maker. So it would therefore seem that the retail outlets are an operating segment. First of all, you need to define, before going to aggregation part, define whether it's an operating segment or not. Because if it's not an operating segment, what's the rule of aggregating or disaggregating? You don't even write it there. So that's why we talked about retail outlet. That's why we defined operating segment. Okay. First of all, business activity. Number two, information is monitored by CDM, chief decision maker. Entity, chief decision maker. These two things are there. It's an operating segment. So retail outlet is an operating segment because it is monitored also and it has a business activity also. So first paragraph for that, 1 mark. For saying retail outlet is an operating segment. Another one, next paragraph. Operating segments can be aggregated. Now you're telling the rules of aggregation. So operating segments, that also not any segment, operating segments. So that's why first you have to go and define as an operating segment or not. After that, operating segments can be aggregated if they have similar economic characteristics. Right? If they are similar, only you will put it in a group. No, otherwise, what's the use of putting them in a group? So if they have similar economic characteristics, you group them, aggregate it. So such segments would normally have similar long-term margins. You have to talk about margins and all because in the case study they have mentioned that margins are significantly higher or lower like that. So if they have a long-term margins that also similar, you can aggregate them, aggregate the segments, and also be in similar in terms of product that they sell. What product that they are selling? One company is selling mobile phone, the other company is selling, let's say, washing machine. You cannot aggregate the two. Their profit margin is different, the products that they are selling is different, the customers that they are serving is different, so you cannot aggregate this two. Okay, they have to be similar in terms of product also that they sell, and the customers that they sell to, and the distribution, all this has to be there. Margin is similar, products that they sell are similar, customers that they're selling to is a similar set of customer, and also the distribution method that they're using is the same distribution method. Okay, for example, they're selling online only to everyone. So now let us relate this to the retail outlet. Yeah. And partly IS 24 also we have to refer, because we told that he's a close family, like he's closely related and all, he's a friend, former friend and all. That's why IS 24 also comes. But before, that's why another 1 mark is there. That's how you are getting the 4 marks. So another mark you'll be getting here in the third paragraph. So 1 mark here, 1 mark here, 1 mark here, and 1 mark for IS 24. This is how you are getting the 4 marks. Okay. Do you see the answer? It's given in 4 separate paragraphs rather than given together. So don't confuse. Whenever you are given a one whole question, break down like this into pieces of small information. Then you will know how to write. Okay. For example, this IFRS 8 is given to you. This is an example. Use this as a guideline to answer any question in SBR. They told it's 4 marks. Operating segment, it IFRS 8, right? Operating segment definition, 1 mark for this. Another mark for that for the aggregation policy. What are the aggregation rules? Similar product, similar distribution methods, all those things. Another mark. So you break down like this: first paragraph, second paragraph, third paragraph. What is it? Talk about the retail outlets. That in this case, this is this, and finally IS 24. In this case, IS 24. Okay, because we have a part of IS 24 there. So 1 mark. Break down like this, then exactly you will know how many paragraphs, how many points you need to write. This will minimize your stress also, rather than panicking, oh god, 4 marks, how am I going to get the 4 marks? Because you are thinking in the wrong direction, that's why you're not getting the points. If you know to break down like this, big amount of marks you will be able to write more efficiently and more effectively. Okay, so now coming back to the question, we were in paragraph 3, retail outlets. They have a different margin to the rest of the gardens activity. It's given in the scenario. Okay. Furthermore, the retail stores sell to the customers face to face, isn't it? They're selling face to face, they're not selling online. Whereas the rest of the gardens business is conducted online. So that means their distribution method is also different. Margin is also different. This is general guidelines you are giving. You see, margin, similar in terms of product, customers are the seller, distribution method. Here now you are referring, linking this to the case study. You are giving the points from the case study. What is garden doing? Margin is different, selling to different customer, selling face to face, and rest of all are selling online. You know, these points are only explaining in detail, referring into the case study. Okay. With goods dispatched to customers via couriers. Okay, so this suggests that retail outlets do not have an economic characteristic similar to the other operating segments. As such, retail outlets should be disclosed as a separate segment. You cannot aggregate it. It does not have similar characteristics. Similar characteristics means they have broke down it. What is the meaning of similar characteristics? Having long-term profit, similar margins, similar products, similar customer, similar distribution methods. So they don't have any. That's why they have to be disclosed as a separate segment. They cannot be aggregated. But assuming, when you are disclosing it as a separate segment, also assuming that they exceed the quantitative threshold that is outlined in IFRS 8. Okay. Here they have not mentioned anything about the quantitative threshold, whether they meet or not. Neither they have given you any figure, so you don't have to worry about it. Okay, calculation and all. Now we are coming to the part of IS 24, which is related to IFRS 8. This is what you need to know. Sometimes in a standard also they can ask you another standard. It could be a combination of 2-3 standards in one single issue. Okay, you have to be prepared for it. It's not just one issue, sometimes it could be 2 standards also that you need to use, like this question. IFRS 8, we were thinking it's only IFRS 8, but IS 24 is hidden inside that. Many people miss this part. They miss out this part. The hidden part they miss out. IFRS 8 is easy to understand because operating segment. What is there? But this part they miss out. Make sure that you are able to identify this missing standards in a main standard and a big standard. Okay, small standards. This will give you additional marks. So IS 24, related party disclosure. They are talking about the close family member of a director. Okay, so if he's a close family member, he's a related party of the reporting entity. But definition of a close family does not include friends. He's a friend. This means that the purchase of the trade and the rest of the retail business should not be disclosed as a related party transaction. See, even if it should not be disclosed, you might be thinking, if it's not a related party, the friend is not a related party, why are we using IS 24 then? We could simply ignore it. Because he's not a related party. No, it's not like that. Whenever they mention that he's a friend, he's someone close to him, he knows him, you have to apply IS 24. Whether you recognize it, disclose it as a related party or not, that's not important. Irrespective of that, you have to mention IS 24 in your answer, because they have told you that he's a close family member or a friend or a nephew, niece, some relation they have told. You have to mention IS 24 there. That's an indication that IS 24 you have to use. Whether he's a related party or not, that's not an issue. Otherwise, they would have not mentioned it. Okay. So when you're purchasing, so this means the purchase of the trade and the assets of the retail business. This should not be disclosed as a related party transaction. Okay, now we are coming to the ethics and the professional issues. These are one. Okay, so don't get confused between these two as separate. It was in the past paper, that's why it is taken as separate, but it's same only now. Coming to B. So if you see, okay, if you see the marking scheme first of all, okay, so 434 is already given here, and if you see discussion of ethical principles, for example, the principles that has been breached and all 2 marks, but applying this to the scenario itself is 5 marks. Okay, that means you have to give 5 points. So now let's see. As I always say, this first paragraph always you can copy paste it. You can just memorize it or remember it however way you want to remember it. You can use it, but you can use this in your answer. Professional marks you will get. Okay. So here you are talking about the purpose of the financial statement, that is to give the faithful representation. Okay, so that investors, lenders can make economic decisions. Then accountants have a social and ethical responsibility to issue financial statements and does not mislead the public. All those things you're talking in the first paragraph. Okay, also deliberate falsification is unethical, and also any manipulation of accounts will harm the credibility of the profession, since the public assume that the professional accountants will act in an ethical capacity. This answer is question. The first paragraph is answered in many different ways, so you can answer it in different ways, but make sure these words are there. Okay, that they have ethical responsibility, faithful representation. Okay, now linking this to the specific accounting issue from the second paragraph onwards, here you cannot repeat. Here you have to be specific to the scenario given to you. A faithful representation is deemed to have been provided if the financial statements are prepared in accordance with the IFRS. Then only you can say it's a faithful representation. If they are not complying with the IFRS, you cannot say they are faithful representation. So it would seem that the financial statements currently breach a number of key standards. What are those standards? IFRS 2, IAS 24, IFRS 8. IFRS 2 not recognizing the expense. IAS 24 not disclosing it. Okay, IFRS 8 aggregating. So they are not going by the standard. The standard says they should not do all these things, they are doing it. So they are not being faithful representation. Now, main thing is what is the impact of that mistakes or omissions on the financial statements is the main thing in the ethical answer, any ethical issue. So now, starting with the share-based payment. Okay. Now you can use separate paragraphs for each document. For example, this talks about share-based payment, IFRS 2. This paragraph talks about the son, related party, and this one talks about IFRS 8, operating segments and all. Okay, and finally, this is your action, conclusions, recommendations that you are giving. So make sure that you divide your answer like this in a paragraphs and all. So moving towards IFRS, the first one, they have omitted it, right? So omitting the share-based payment transaction from the financial statements has inflated the profit for the year because it's an expense that you didn't recognize in the profit and loss account. So profit went up, which could impact the shareholder perception of the underlying performance. It could impact. That means shareholder might be thinking that the company's performance is going good off the garden, but in fact it's not. So moreover, the shareholders have already been critical about the directors' remuneration. Also, they have been critical about the directors' remuneration. This is from the background information you are writing here. In the background, they have told, okay, that they are taking excessive remuneration and also. So omitting the transaction. So this is also kind of remuneration to the directors only, okay, the share-based payment you are giving in terms of shares. That's it. There you are giving in cash, here you are giving in share. But both are remuneration. It's a part of a package. So if you don't disclose this, then, So omitting this transaction may have been a tactic for deliberately concealing this additional benefit. Yes. Directors do not want to show that they are taking this additional benefit. They want to conceal it. Because shareholders are already worried about, they are already concerned, they're critical about the directors' remuneration, that directors are taking excessive remuneration and all. That's why they want to hide this by not disclosing it, by omitting it entirely, which is wrong according to IFRS 2. Coming to the second thing. So whenever something is wrong according to standard, that is an ethical issue. Okay. Second, IS 24. It would seem that recruitment and remuneration of the son of the finance director and sales director. Recruitment of whom? Of the son, because he's doing internship there in the garden. And remuneration of whom? The sales director. So recruitment and remuneration of the son of the finance and the sales director has been deliberately concealed. They're related party, don't forget that. So although it is claimed that he's being paid a salary, even though they're claiming that the salary is paid in line with the market rate, questions may still be asked about the appointment, such as, is this the best person for the job? Because you're just appointing, or you're just appointing because he's your family member. Is this role really required? Is this the best use of the company money? Some users of the financial statements might conclude that the directors are putting their own interest and the interest of their family members above those of the other company shareholders. Now coming to the last one, IFRS 8. Garden's finance directors has wrongly aggregated the entity's operating segments. This might be an attempt to hide the poor performance of the near acquired retail outlets. It's easy to see when you aggregate, it's easy to hide those segments where your performances are poor, because it goes and it aggregates with those who are performing good. So good minus poor, you don't know, you are just seeing the overall picture, only one profit and loss, but you're not seeing the in that which is the one which is the loss making segment. You don't know it. It's easy to hide when you aggregate it, but when you disaggregate separately, when you disclose, it's easy to identify that this is the segment which is performing poorly. Okay, and since it's also a newly acquired retail outlet, so there are chances that performance will be poor. Okay, and thus avoiding criticism and scrutiny of the transaction. So where's the trade and the assets were not purchased from a related party. Okay, the trade and assets, they were not purchased from a related party, but the fact that the transaction took place with a close friend of one of the directors raises questions about the integrity. You have to mention this words, these are ethical principles. For this only you are getting marks. 2 marks are for this, to identify the correct ethical principle which is being breached. This is integrate, because you're not being honest. And the extent to which the directors more generally, effectively and efficiently using the entity's resources. Okay, also the extent to which the directors are using the entity's resources. It raises the questions, the integrity. Finally, conclusion, where you are giving actions, recommendations on what the accountant should do. Professional marks you will get here also in the action, the last paragraph. Okay, the question answers you to require from the perspective of the accountant. Okay, so you have to state that the ethical principles, which ethical principles that has been breached, and come with the practical steps that accountant should take to resolve the ethical issue. That means you have to give in the order. Okay, you can exactly take from here, copy paste this. First paragraph, last paragraph, you can copy paste. In between, you have to be specific to the scenario, because it's the same actions you are giving. Do this, take legal help, take professional help, resign. You see, let's read the answer before we go to the marking scheme. The accountant should remind, this is the role of the accountant we are saying. Again, we'll go to the ethical question just to see whether they have asked from the accountant's perspective or not. From the perspective of the accountant. So whenever they say, think about the accountant, forget about the other party. Because he's been threatened, no? The accountant has been threatened. So the accountant should remind the directors the professional ethics are an integral part of the framework from which professional accountants operate. First of all, remind the one who has been threatening you, that is the director. The accountant should do that, number one. Number two, they must adhere to ethical guidelines such as ACS Code of Ethics and Conduct. Make sure that you mention this in your actions. This together only 1 mark. Second mark, it would appear that financial statements have been deliberately manipulated. Okay, now still the second mark didn't come. So financial statements have been deliberately manipulated, probably to provide further criticism from shareholders, right? That's why they are manipulating it. And about the running of the company and the stewardship office as well. This would contravene the principles of integrity, objectivity, profit. Here you are getting another mark. It would contravene 3 principles. One is integrity, one is objectivity, one is professional behavior. You have to identify like this. Integrity because not honest, objectivity because it's not being independent anymore, is dependent on the company's performance and on professional behavior. It is not accepted from him being an SCCA member. So professional behavior, brings a discredit to the profession. So professional behavior. Okay. Next, second, records of discussions. So this is your third mark you are getting here. Third action, records of discussions between the whom accountant and the director should be kept. If the disagreements remain, advice should be sought by the accountant from SCCA. This is the fourth. Follow this order. Okay. And if no effective channel for internal reporting of concern, that means no whistleblowing procedures are there in your company that you cannot report to anyone. There is no system like that. Then accountant may need to consider resignation. Number 5. But remember, coming to the resignation, you have to follow all the steps you have to write. Then only at the end you are writing resignation. You don't immediately start by saying, okay, resign. Resignation, no. Or go to law, take legal advice, no. That comes later. First, talk with the director. Second, talk with a person other than the director, for example, non-executive director, audit committee and all. Then you have to seek legal help, professional help. Okay. Then if still the matters are not resolved, then consider resignation. So this order needs to be followed in ethical question always. Okay. This also you can copy paste, I would say. It's very similar. The older thing is which principles are being breached. That's different from case to case. Okay. But mostly it is integrity and objectivity. These two are. And in this case, it's professional behavior also because he knows what he's doing, he's aware, still he's doing, and he's a member of SCCA. So it's a professional behavior. Okay. Now coming to the marking scheme. We have already know this marks because they have given us. But coming this 2 and 5. Okay. Oh yes, we went through the marking scheme here. Okay, so that's it for question number. What is this question? I've been using so many questions till now. I think this is my third video I've been uploading continuously. That's why I forgot the question number also 24 because I've just uploaded 22 and 23 is uploading now and this I will be uploading right now. So see you in question number 25.